Hey everyone, what's going on? It's time to do another review of yet another ETF. I'm assuming a high yield ETF, one that plays around with options and provides you the income. And this one is from SoFi, and it's called essentially THTA or THTA. So as you can see, this is their website. It says SoFi Enhanced Income ETF combining treasuries and options. What is that? See, it's covered. It's not, the mobile version is not really friendly. And options trading to pursue monthly income. So what is THTA? THTA is an alternative investment strategy that uses an institutional level approach and democratizes it to be available and easily accessible ETF. So they do what? Three things. They generate income. First one's always generate income with these, and I apologize as I am sipping coffee during this. The strategy seeks to generate income by holding short duration U.S. Treasuries without material interest risk while capturing enhanced income by selling volatility premiums using high probability defined risk option spreads. That's a lot of words right there. They leverage U.S. Treasuries. The benefit of this alternative strategy is leveraging the U.S. Treasuries as collateral, which we're familiar with that with Yield Max. And they balance your portfolio. This strategy can potentially generate income in a range of market conditions. Investors can use THTA as a higher yield product from alternative income to balance their portfolio. Okay. Scrolling along. Why THTA? Number two, look at that high potential yield. It's not number one though. Number one is disciplined yet opportunistic. THTA is rooted in U.S. Treasuries but looks to capitalize on the volatility of using option spreads. And number three, potential monthly income, whatever the market conditions. Okay. The most important sentence of the fund objective. THTA seeks current income by combining a strategy of holding U.S. government securities, including U.S. Treasury bills and Treasury bonds, with a credit spread option strategy. So this one doesn't just sell calls, it doesn't just sell puts, it also buys calls and buys puts through a credit spread. But we'll get into that. Here's some details on the fund. The ticker is THTA. They incepted November 15th, so pretty damn new. Assets, so far only 1.5 million. Net expense ratio, well, it's half of Yield Max, 0.49%. Shares outstanding so far, 75,000, which is nothing. But again, they're just brand new. The price is at $20. Here's some documentation. We'll get into the statutory prospectus very soon, and we'll also get into the holdings, but scrolling along, I think that's it for the website. And I don't even know what else SoFi offers, right? Did they even say? Products. Oh, yeah, that's not even... I don't know what other ETFs they offer. I just know THTA. I guess SoFi is one of those up-and-coming banks, right? That's mainly online, as far as I know. I should probably check them out, actually. But anyway, let's get into the statutory prospectus, which, as you know, I always save it under my files, and I highlight the important items, and then I'll save it in my Discord for you guys to review later if you so choose to do so. And as always, this is not financial advice. I'm not a financial advisor. This video is for fun and entertainment. So hopefully you're having fun. The date of the prospectus, as this is a new fund, November 12th, 2023. Scrolling along. Okay, objective, seek current income. That's a good sign. And again, the expense annually, 0.49%. Okay, just so you guys know, I highlighted a decent amount of things. There's a lot going on here. And keep in mind, I've never done credit spreads when it comes to options. I've only sold calls or sold puts. So this is kind of a learning curve for me too. I know what credit spreads are. I just was never brave enough, to go down that road. Which honestly, it's going to make me want to track this fund. So I hate to even say that, but I may have more work to do. This is becoming like a part-time job, almost full-time job. All right, so let's get to it. So they hold U.S. Treasury bills and U.S. Treasury bonds, and they do a credit spread. And here's the breakdown of their asset holdings: 2 to 5% cash, 95 to 100% treasuries, and they'll do 90% of that in credit spreads. Okay, cool. The duration so the treasury bills, typically they'll have one, they'll buy them, then it'll go out 1 year in expiration. And look in green, guys. Look who is involved with this fund. Ziga Financial is the sub-advisor. As you know, Jay Petrocelli, who's part of YieldMax and Defiance, is now part of the SoFi ETF. Small world. I guess they don't have enough sub-advisors out there. Maybe we should all get together and create a sub-advisor group. Anyway, so they'll generate annual interest income and capital gains. At the same time, the fund will purchase, buys, and sell, put or call options on the following three major equity indexes: the S&P 500, the NASDAQ 100, and the Russell. So they'll buy a call and sell a call with a spread on the indexes, these three indexes, or they'll do puts, put spreads on that too. So Ziga manages the fund using high probability options strategy. I guess they call it HIPPOs, another crazy name, or the strategy by which it seeks to provide risk-adjusted returns for the fund that are uncorrelated to both equity and fixed income markets by using an alternative trading strategy and reducing the need to predict future market movements. Okay. Credit spread strategy overview. So basically, same type. I didn't highlight the beginning. So it's the purchase, sale of options, the same type of puts or calls with respect to the same index and the same expiration, but at different exercise strike prices. So they'll buy a call and sell a call, or buy a put and sell a put, and they'll use, obviously the same index, they'll use the same expiration date, but the strike price is what's different. The fund will pay premiums on the options, puts or calls that purchases, and it will receive premiums when writing those options for a net credit, meaning the premium received is more than what is spent. So since they sell a call and sell a put, they'll sell a call and they'll buy a call. The buy call will be cheaper than the credit you get from the sell call, if that makes sense, and vice versa with the put. The maximum gain for the fund on any given credit spread is equal to the net premium the fund receives. Okay, this just means the options premium you collect. The maximum potential loss for the fund for any given credit spread is equal to the difference between the strike prices of the options on the index multiplied by the number of contracts or units subject to the option minus net premiums received. So there is no infinite loss. The maximum loss you can get on one of these options is the difference between the strike prices, minus obviously the net premium you received. The fund's returns will be driven by the interest and capital gains derived from its portfolio U.S. government securities and its credit spread strategy. So as you know, the interest rates are still pretty high. So we're getting money from, the U.S. government securities, which is pretty good. One day interest rates will go down, so this will no longer be a huge benefit. But right now, let's take advantage of it. Ziga analyzes market data to decide when and at what levels to place spreads for the fund. The fund's holdings may include bullish, bearish, or neutral credit spreads. When appropriate, it can hold neutral positions that lean both bullish and bearish simultaneously. So long story short is they're going to predict what the market's going to do, and they're going to do options based on that. Obviously, you and I probably don't have the time to do that, nor the knowledge. So to pay 0.49% for an expert to do that and make us money on it, I mean, it sounds pretty good to me so far. Zega constructs a portfolio for the fund that, I'm sorry I highlighted this whole paragraph, but I think it was worth it. Okay, Zega constructs a portfolio for the fund that it believes is not highly dependent on broad stock market fluctuations. This is because the fund uses out-of-the-money credit spreads, which can yield positive returns when an underlying index doesn't move much. The strategy also proves beneficial if at expiration the strike price of these credit spreads remain out of the money. In a bullish stance, the fund typically sees positive returns unless the stock market value nears or falls below the strike price. Conversely, in a bearish stance, it benefits unless the stock market value nears or exceeds the strike price. Okay? All option positions held by the fund are exchange traded and collateralized with cash and cash equivalent. The fund will not establish a credit spread position unless Zega concludes that the potential rate of return exceeds the probability of a potential loss. Okay, I'd hope so. Scrolling along. A lot going on with this fund, right? Oof. A lot to learn, though. Okay, the investment advisor is Title Investments, obviously familiar name. Investment sub-advisor, Zega. And look at that. There is Jay. I mean, how much time does this guy have? He's he's stretched a little thin here. Hopefully he has good people working under him. All right, the fund's index option strategy relates to the following three indices: S&P 500, NASDAQ 100, and Russell 2000. Works for me. All right, I highlighted all this, so let's go through it. The following provides a high-level description of vertical credit spreads and options generally. Vertical credit spread. So what this is, it sells one option and simultaneously purchases another option of the same type, either put or call, with a different strike price but the same expiration date. Okay. Credit put spread. All right. This sells a put option and simultaneously buys another put option on the same underlying asset with the same expiration date but a lower strike price. And you would do a credit put spread when you anticipate a moderate rise or stable movement in the assets, or the index, we should say. All right, credit call spread. This is where you sell a call option and simultaneously buy another call option on the same underlying asset with the same expiration date but a higher strike price. And you would do this when you expect a modest decrease or stable movement in the assets, aka index. So I know this is a lot, guys, but I'm gonna have to cover this in more detail, in later videos. So they have like long and short legs, more probably new terms for everyone. I know you option guys, this is not new, but long leg, the option that the fund buys, which gives them the right to buy or sell the underlying asset. Short leg, the option that the fund sells, which obligates them to buy or sell the underlying asset if the other party to the contract decides to exercise their right. Okay, whatever. All right, bullish stance. When they have a bullish stance, the fund will generally use vertical credit put spreads. Okay, so all this means is they will sell put options and they'll buy another put option on the same index, same expiration, but a lower strike price, making it cheaper than the sold put, right? And then obviously they go through the scenarios, but I'm not going to go through all that. If they have a bearish stance, then they will do a vertical credit call spread strategy where they'll sell a call and then they'll buy a call, again, same expiration, same index, but a higher strike price. Okay. Scrolling along, again, I'll save this in my Discord under the prospectus channel. I believe there was one more section I highlighted, maybe not. Nope, that's it. 20 pages, not terrible. So now let's just go through the holdings. I'd like to look at the holdings to get an idea of what they're actually doing. So here's the holdings. So the top four lines, as you can see, are treasury bills. expire May 9th, 2024, February 27th, 2024, August 24, and March 25. Wow. Okay. Maybe they think interest rates will go down, so it's good to have one that goes out that far. Now, if you go from the bottom, the second and third from the bottom, you'll see the spread. So they have a put, right? So a put, if we go back to the prospectus, right? Why would they do a put? I believe it's because they're bullish, right? So bullish stance, they would sell a put and buy a put. Okay, so they're bullish. So they bought a put for 4,000 and sold a put for 4,050, right? And I don't know when they did that, but it expires December 8th. So there are two potential outcomes here. If the index's price stays above the strike price of the written put, which means the sold put. So the sold put is 4,050. So if the index's price stays above 4,050, the fund gains. Loss scenario. If the index price drops below the strike price of the written put, the fund faces a loss. So we want it to be above the 4,050. Okay, so let's go to market wash. Oh God, so it's 45.1402. I apologize. I know it's sideways, but the Market Watch app needs to be updated so we can go landscape. So we're above the strike. So this is already a win. But it expires December 8th. So what are they going to do? They could roll it, right? And move the strike prices up. Will they? I don't know. I don't follow this one. Will I follow this one? I don't know. And then there's cash on the bottom. That's about 15% of the weighting. So yeah, pretty cool. Outstanding shares, 75,000. Net assets, okay. This is as of 11/20, which is Monday. And that's pretty much it. I didn't see anywhere where they have an expectation on yield. My guess is the yield is, maybe in the 20% range. I don't know. I have no idea. It's not going to be Tesla range or Coney range or things like that because they're doing credit spreads. And credit spreads, they limit the downside of, potential. In Yield Max, they only sell calls. And there is no limit to the downside potential if the underlying tanks. This one, plus they're using the indexes, which is even safer. So these funds are pretty good. If you can get like 20%, I'm buying it for sure. 15%, yeah, I'll still probably buy. 10%, I don't know. But we'll find out soon. I don't really see a distribution calendar. Do they have that? Sorry for the scrolling, but I'm just thinking about that now. There's a little drop down here. Well, that doesn't help. Yeah, they don't have anything on distribution dates yet. I'm sure they will soon. So we'll see when they pay, and we'll see what the distribution is, and we'll see what the yield is. Hopefully it's a good one. But again, this seems like a pretty cool fund. SoFi Enhanced Income ETF, THTA. Let me know what you guys think about this fund. If you own it, if you're going to buy it, why? Is it a great fund? What do you think it's going to yield? Are you buying it because of the downside protection? Or are you just buying it to diversify even further? Either way, let me know in the comments. If you enjoyed this video, please click like. If you want more videos like this for other funds, please let me know the fund, all right? Only if it's a, income ETF, though, high income ETF, because that's really my focus. I will do reviews on the underlyings of YieldMax, though. I know there's a request for that, so I will get into that at some point, too, all right? As always, guys, not financial advice. Hope you enjoyed this content, and have a great day. Later.